Welcome to the Valmika Property Investing Podcast. I'm JP, your host and the founder of Valmika Buyers Agency. With my background in investment banking, I'm here to share Wall Street tips and secrets for building a top 4% property portfolio. Let's dive into the world of property investment together. Welcome back to another podcast, everyone. Today we are tackling a hot topic indeed, and it's called negative gearing. We're going to delve into what it means, how it works, and the potential benefits and risks to consider. We'll also explore alternative positively geared properties and help you decide which strategy might be the right one for you. So let's get straight to it. What is negative gearing? So let's take a simple example to define it. So negative gearing occurs when the annual expenses associated with an investment property, which includes loan interest, property taxes, maintenance costs, and other outgoings, outweigh the rental income it generates. So in simpler terms, you're making a loss on paper each year on your investment property. So let's take an example. Let's say you purchased an investment property for $500,000 with a mortgage and the annual rental income is $20,000 per year. However, your annual expenses, which incorporates interest, taxes, and maintenance, total $25,000. So in this scenario, you're negatively geared by $5,000 per year. So you're making a loss of $5,000 per year. So this is where negative gearing comes in. And Australia is one of the unique countries in the world that has this. And this is one of the reasons why we've had such great property increases in value over the year. So what is the lure of negative gearing? So there's the potential tax benefit. So the key attraction for negative gearing is the tax advantage it offers. So in Australia, you can offset your rental property losses against your other taxable income. So that includes your salary and wages. This is if the investment property is in your name. Then you can write that negative gearing component off your taxable income. So what does this mean? It can potentially reduce your overall tax bill. So here's an interesting statistic. According to the Australian Taxation Office, the ATO, over 1.2 million Australians claimed negative gearing deductions in the 2021 to 2022 financial year. So this tax benefit is quite popular in Australia. So let's take an example of how this tax benefit works. So if we continue with our previous example, if your marginal tax rate is, let's say, 30%, you can claim a tax deduction of that $5,000 loss times 30%, which equates to $1,500. So this reduces your overall tax liability. So what are the potential advantages of negative gearing? So negative gearing allows you to take advantage of capital growth potential in the property. So this ideally happens if the property's value will increase over time. So that capital appreciation needs to offset the initial losses and potentially generate significant profit when you sell. So negative gearing can be a strategy for getting into the market and building a long-term property portfolio. The other potential advantage is for savings. So the ongoing costs associated with negative gearing can instill that financial discipline in the individual. So you'll need to have a plan to cover the shortfall and potentially leading to better budgeting habits. So negative gearing will basically starve you of a bit of cash flow every month. And that will instill discipline in you to budget for that starvation of cash flow. And that starvation of cash flow allows you to come up with a plan that lets you stay in the game to allow the property over time to appreciate. But that appreciation must be greater than the negative gearing loss that you're incurring, plus the tax benefit. Otherwise, you'll be losing money. So here are the important considerations and disadvantages to consider when buying negatively geared property for investment. So number one, you have to have a long-term strategy in cash flow. Negative gearing is a long-term strategy. It's not a set and get rich quick fixed strategy over the course of 1 or 2 years. It's crucial to have a clear plan for capital growth on the property and sufficient cash flow to cover those ongoing costs. If you don't have the ability to have that cash flow, you will lose the property in the end due to the mortgage securitizations that the banks will have. So you need to carefully plan for several years of cash flow at least. So have a buffer. Now, of course, the more negatively geared the property is, the higher the risk is. So you are relying on the property increase in value, in capital value. If it doesn't, you're going to be losing money. So there's substantial market risks when you're buying negatively geared property. So there is a risk that the property values may not grow as expected, leaving you with a property that generates ongoing losses. So you need to have done your research and make sure that you are confident enough that the property you're acquiring that is negatively geared will outdo those losses through capital appreciation. Of course, you've got to include in your forecast interest rate hikes, because that will increase your expenses and worsen your negative gearing position. So that is a very important metric to consider when purchasing negatively geared property. The second disadvantage is that you're going to have limited cash flow for reinvestment. So if your strategy is to grow an investment portfolio as quickly as possible, with limited cash flow, your ability to reinvest your equity or your cash flow to acquire another property becomes limited. So you have to wait for that capital appreciation before there's enough equity to reinvest into another property. And even then, you might not be able to acquire that property because your cash flow will still be too negative to be able to afford the interest payments on that property. So you need to consider that before purchasing a negatively geared property. Lastly, there's that psychological pressure when making ongoing losses, and this can be stressful. So purchasing negatively geared property is not for everybody. It's for people who are sure of their market, who understand the market well, and who are confident in the ability to handle the negative cash flow pressures, as well as be confident enough to know that the properties will outdo, the property capital gains will outdo the negative cash flow constraints that you will have. Negative gearing tends to be an older investment mindset. The new investment mindset is increasingly moving towards positively cash flowed properties. So let's talk about the case for positively geared property. Number one, and the most obvious one, is immediate positive cash flow. So a positively geared property generates rental income that exceeds your expenses, providing immediate cash flow that you can reinvest or use to pay off your mortgage faster. So this can accelerate your wealth creation. There's also the reduced reliance on tax benefits. So having to rely on making a loss just to get the tax benefits cannot be, for some people, a great strategy to have, especially on the psychological constraints it can weigh on you. So while tax benefits are important, Positively geared properties allow you to focus on the property's intrinsic investment merits, such as rental yield and capital growth potential. So, your capital growth potential sometimes on a positively geared property is not as great as a negatively geared property because these tend to be in less popular suburbs, for example. However, the combination of having a positive rental yield makes them a lower risk in terms of staying in the game. And with the combined capital growth that they do have together with the positive cash flow, sometimes can actually exceed the returns that you get on high demand, negatively geared suburbs where property resides. The last case for positive gearing is peace of mind. So the stability of positive cash flow can provide peace of mind and reduce financial stress, as we've already alluded to prior. Right, so you need to make an informed decision. So seek professional advice. Before embarking on any investment strategy, it's important to consult with a qualified financial advisor and accountant. They can assess your financial situation, your risk tolerance, and your investment goals to guide you towards the most suitable approach. Secondly, and I can't emphasize this point enough, thorough research is very important. Conduct thorough research on the property market and specific locations you're considering. Understand rental yields, vacancy rates, and long-term growth projections for informed decision making. This is very important when going into negatively geared. You need to be confident in the capital growth of your asset. Lastly, consider your stage. So early investors with a long-term horizon and access to additional capital might consider negative gearing as part of a portfolio growth strategy. For investors that need to seek immediate cash flow and lower risk, positive gearing might be a better fit. I'll give you a example to end off this podcast. So we acquired a negatively geared property for one of our clients towards the end of the bear market in 2023. So there was a property in Manly. It was an apartment, and the rentals that it was bringing in were way under market. And as a result, when they were looking to sell the property, number one, it was in the bear market, so there was less competition to buy it. And secondly, it put purchasers off the property because the rentals were so far under the market, and the rental term was still for another 7 months. So what we did was we used the bear market and the fact that the rentals were significantly below market to negotiate a better price. Still a negatively geared property because at the end of the day, it's Manly. It's still a suburb that had a lot of focus, but it gave us the negotiating power to acquire the property at a lower purchase price. Now in April, the rentals are coming up for renewal, and with the increase in rentals since the purchase, where the rentals were already under market, we were able to increase the rentals by 40%. So the yield that you would typically get in a jurisdiction like Manly is around 2.5% to 3% gross. We're able to achieve over 4.5% growth. And we believe that with interest rate cuts coming towards the end of the year, towards maybe towards the beginning of next year, the bull market will start to gain traction. And you're gaining traction in a bull market already with a much higher yield than you would to comparable property in the market, just from purchasing the property at a good time and taking advantage of lower rentals in the actual asset. Now you might think, okay, that's a very rare situation where you'll find rentals below market. You'll be surprised. There's more out there than you realized. You just need to be able to put the time in to finding those properties. And that's where we do our due diligence and our homework. We're very good at the research component, and that's how we find these good assets to invest in. I hope this was a beneficial episode. If you like the episode, please help us out, keep the lights on and give us a like, and please leave a comment below. See you in the next one. Thanks for tuning in to today's episode of the Valmika Property Investing Podcast. If you're interested in our services, please visit us at valmikaproperty.com. Remember, the content shared in this podcast is for entertainment purposes only. For personalized financial advice, always consult your trusted financial advisor or professional. See you in the next episode.